Welcome to Philip Mastermind. I'm Kim, and in this webinar, we'll be sharing our thoughts on the Malaysia market. Malaysia market has been underappreciated, with the KLCI only recording 2 positive returns in the past 10 years, which is in 2017 and 2020. This is mainly due to foreign fund selling, inconsistent policy follow-through, along with external forces such as the US sticking to higher rates for a longer period and a sluggish recovery in China. What's more, the KLCI, which is primarily dominated by the traditional sectors such as financials, plantation, telcos, and utilities, continue to maintain a limited appeal for investors. However, things have improved since the second half of last year, and this strong momentum persists into 2024, with KLCI registering 6.7% gains year-to-date as of February 2024, indicating signs of renewed optimism towards the Malaysia market. Top performers are utilities, energy, and construction sectors, extending their gains in 2023, while healthcare is the laggard. Despite the recent rally, we hold a positive view on Malaysia market over the medium to long term, and we have identified various investment themes that we believe will continue to shape the future outlook of Malaysia market. The primary theme that we believe will lay the groundwork for 2024 is the anticipation of approaching interest rate cuts by the Fed. While the magnitude or the frequencies of rate cut remain uncertain, and the Fed officials often cite that any monetary policy decision is data dependent, but the prevailing consensus leans towards anticipating a rate cut. This is mainly due to falling inflation in the US and some emerging signs of a weakening in the labor market. We believe the fall of interest rates expected in 2024 bode well for growth-oriented sectors, which will see valuation re-rating, and import-dependent industries, which will see a reduction in the cost of imported goods, hence leading to a better margin. Furthermore, historical data indicates that a rate cut leads to a weaker dollar and outperformance in the emerging markets, which could potentially benefit the Malaysian market as well. According to UBS research, FBM KLCI slightly negatively correlates with ringgit movement, and with every 1% depreciation in the ringgit, FBM KLCI declines 0.33% on average. As we expect the ringgit to strengthen by year-end amid potential Fed relief, we expect the Malaysian market, especially the large caps and the laggards, may benefit from the improving sentiments when the ringgit appreciates. Theme 2. Stable domestic political environment. The Malaysian market has been G-rated since 2018 amid political uncertainty, but we have seen modest improvement in the political environment, especially since the conclusion of state election last year. 2024 should be a take-off year for Malaysia's medium to long-term economic transitions and reforms outlined in the blueprints, master plans, roadmaps, and legislations announced last year, including Madani, NETR, NIMP, 12 Malaysia Plan Midterm Review, Fiscal Responsibility Act, and Budget 2024. These policies aim to rectify the structural imbalances in the country. Malaysia should also see higher productivity and stronger fiscal balance moving forward. Fiscal reforms and economic restructuring are the top priorities of the government's agenda, with the key element being implementation of the targeted rationalizations of a few subsidies in 2024 to lower budget deficit as per Budget 2024, 4.3% of GDP versus estimated 5.0% of GDP in 2023, and ultimately capping the deficit spending to no more than 3% of GDP under FRA and Madani economy. This is on top of FRA's target to lower government debt to 60% of GDP in 3 to 5 years' time. These policies introduced by the government would continue to be the pillars of various investment themes and ideas going into 2024. Theme 3. Reversal in foreign outflows. Foreign investors' underweight position on Malaysia is bottoming out, with January and February foreign shareholdings in Malaysia equity market stands at 19.6%, 19.9% respectively, versus all-time low of 19.5% in December 2023. After experiencing an outflow of funds by foreign investors since 2018, totaling close to 50 billion ringgit Malaysia, we have observed a reversal of this trend, especially since the conclusion of state elections in the second half of last year. In terms of sectors, foreign investors favor constructions, utilities, and property, which explain the outperformance last year and have now turned more positive on the financial sectors in 2024. To also note, financial sector account for about 1/3 of KLCI weightage. Finally, there has been a lot of concerns about the ringgit, but on a positive note, its undervaluation served as another reason for foreign investors to consider Malaysia as their investment destination. Theme 4. Recovery in the global tech cycle would benefit Malaysia tech and E&E. Following a decline in 2023, we are seeing the beginning of an upturn in the global tech cycle, which should boost global trade. Specifically, the WSTS is projecting a rebound in the semiconductor sales at an annual growth rate of 11.8% in 2024 versus a decline of 10.3% for 2023, to be driven by a broader recovery in the mainstream applications within mobile, automotive, and industrials. WSTS expects a recovery in inventory replenishment, a rebound in smartphone shipments, as well as improving consumer sentiment across the board. Apart from tech-heavy markets, including Korea and Taiwan, Malaysia will also benefit from the recovery in the tech, given that the tech sector accounts for 6% for our country's GDP. What more, the gradual recovery in tech cycle is supportive of Malaysia's tech export baskets, i.e. the E&E exports, which is largely related to semiconductor assembly and testing, which comprise 40% of the exported goods. Theme 5. Strong economic fundamentals. For the full year of 2023, Malaysia's GDP expanded by 3.7% versus 2022 at 8.7%, which was lower than the official target of 4%. This lower than expected GDP growth upturn will provide a favorable base effect for this year's economic outlook, in addition to several positive growth catalysts including global tech upcycle, tourism recovery, initiatives outlined in the National Master Plans, and realization of robust investment approvals since 2021. Although the first half could still be bumpy, the second half is expected to see a meaningful pickup as global monetary conditions start to ease. According to Bloomberg consensus, Malaysia is expected to record 4.4% GDP growth this year, while inflation is expected to stay low at 2.5% and unemployment rate at 3.3%. On the monetary policy, BNM's last rate hike in May 2023 brought the OPR to 3%. We do not expect further tightening to take place given the slowing growth and cooling core inflationary trends. We do not expect BNM to cut policy rates in 2024 as Malaysia's inflation risks are tilted to the upside due to partial subsidy rationalization. Furthermore, BNM has not tightened policy as aggressively as other central banks in the region. Its policy rate is still about 25 bps below the peak of 3.25% over the past decade. Finally, according to Bloomberg consensus, ringgit is expected to appreciate to 4.50 by year-end. In terms of positioning, we think Johor, Sarawak, and Penang thematic play will continue to play out in 2024. The three states of Johor, Sarawak, and Penang contributed an estimated 26% to Malaysia's real GDP growth in 2022. We see excitement in these three states driven by catalytic developments and their longer-term growth plans. Besides a new king from Johor, the Johor-Singapore Special Economic Zone should improve cross-border good flows and FDI, especially by the global MNCs who want to co-locate in both Singapore and Johor for strategic reasons. Furthermore, the new infra developments are to be set up to support the higher economic activities, which would benefit property, construction, utilities, and RE. Sarawak is fast-tracking the implementation of its post-COVID development strategy 2030, aiming for a consistent 8% annual GDP growth. Less than 25% of the state's 20,000 megawatt hydro potential has been harnessed so far, underpinning plans for green energy exports and green hydrogen production. Sarawak is also investing in intra-urban and statewide connectivity to support tourism and logistics, as well as potential for multiple oil and gas projects. Overall, this would bode well with property, construction, energy, and utilities sectors. In Penang, catalytic projects including PI expansion, Balapas LRT, Silicon Island development, health and medical hub, as well as the broader recovery in the tech cycle would benefit property, construction, utilities, and tech. Finally, tourism recovery is also a theme that we are looking at. new flight routes, Asia fleet expansion, MM2H revamp, visa-free programs, tax refund, budget allocation and airport expansion would benefit gaming, consumer, healthcare and REITs sectors. Malaysia, home to many chip testing and packaging facilities, is the 7th largest E&E and semiconductor market in the world. Over the years, we have seen MNCs such as Infineon, Intel, Broadcom, Texas Instruments, and more setting up plants and production lines thanks to our strategic locations, pro-business policies, mature infra development, skilled workforce, and multiple investment incentives. FDI and DDI are also on the rise as Malaysia remains attractive for investments. According to MIDA, as of the first 3 quarters of 2023, the total approved investments reached 225 billion ringgit, with DDI contributing 44%, FDI contributing 56%. This figure not only surpasses the full-year target of 220 billion ringgit set for 2023, but also marks a 6.6% rise compared to the previous year. In addition to the approved investment figures, several investments have also been announced for the period of 2021 to 2024, which are anticipated to materialize in the upcoming period. These include Intel, Amazon Cloud, Tesla, and investment commitments from countries such as US, China, Korea, and Japan. We are positive that the increased FDI will benefit sectors such as technology, specifically semiconductor and data center, as Malaysia's abundant natural resources and high-skilled workforce would stand out as its competitive advantage to attract FDI. While the large cap stocks stand to benefit from the renewed foreign interest driven by increased liquidity, which we believe should constitute a core part of the portfolio, we see opportunities in the small mid-cap stocks due to their robust corporate earnings growth as well as attractive valuation. Notably, the KLCI only recorded 2 positive returns over the past 10 years, while the FBM 70, comprising mid-cap stocks, and FBM small cap recorded a positive return over 5 and 6 of the last 10 years. This suggests that despite the Malaysia's KLCI underperformance over the past 10 years, numerous investment opportunities remain for investors to potentially generate alpha in their portfolios. The valuation gap between KLCI and small cap index has considerably narrowed largely due to the small cap's outperformance last year. Further upside in earnings upgrade is expected as a result of the ongoing recovery. From a valuation standpoint, KLCI is attractive, currently trading at 13.5 times PE, 1 standard deviation below the 5-year mean, and 1.3 times price to book, 1 standard deviation below the 5-year mean. The small cap is also attractive, trading at 13.1 times PE, 1 standard deviation below the 5-year mean. In Phillip Capital Malaysia, we have a wide range of private managed accounts that could cater to different investor needs. We have blue chip for value investors and dividend enhanced for yield seekers. ESG matters have gained significant importance for both corporates and investors in the recent years, and our ESG mandates are suitable for investors who want to optimize the risk-adjusted return by constructing a diverse, sustainable portfolio of ESG companies. We also have ETF, opportunity, UT, and other products to meet your unique investment preferences and financial goals. For global mandates, we have Phillip Global Wrap Account (PGWA) that allow investors to invest in international stocks, foreign unit trusts, exchange-traded funds, and alternative investments. Investors are allowed to gain access to more than 23 global exchanges by opening a PGWA account with us. Our unit trust arm, Phillip Mutual Berhad, offers a comprehensive list of local and global unit trust funds that may suit your investment preferences and financial goals. Phillip Dana Aman is our local Sharia equity funds. We also have conventional equity offerings such as the Dividend Fund, PMEGF, Per Fund, and Recovery Fund. For defensive investors, our money market funds and Phillip Dana Muni, a fixed income fund, could also be an option for you. Meanwhile, Phillip Select Balance is a mixed asset fund that invests into both equities and fixed income securities. Last but not least, we also have a selection of unit trust offerings with global and Asia exposure, including Asia Pac Income, Focus China, Phillip Global Star, Dana Dividend, and Global Disruptive Innovation Fund. In the face of a challenging 2023, most of our private managed accounts were able to register positive returns, outperforming KLCI, which declined negative 2.7%. Our humble performance is credited to effective bottom-up stock selection and prudent management practices, which allow us to navigate the market effectively. We mainly concentrate on selecting stocks within the small mid-cap space, which in our view presents a more favorable risk-reward scenario. We also have selected large cap exposure, which are generally more stable and less volatile. Finally, we avoid trying to time the market, focusing instead on investing in companies with strong fundamentals, sustainable business models, clear earning visibility, and a high-quality management team. Separately, both our local and global UT funds are also able to deliver resilient performance in 2023, with some of our global funds such as Philip Dana Dividend and Philip Global Stars funds are able to register strong double-digit returns in 2023. While the past performance is not an indicator of future performance, we remain committed to achieving sustainable performance over the long term. Whether you want to DIY, seek for advice, or let the expertise fully handle your portfolio, our platform, with a comprehensive list of products including discretionary private managed accounts and unit trust funds, can cater to your needs and preferred way to achieve your financial goals. That's all for today. Stay tuned for our next Philip Mastermind. This update is brought to you by Philip Capital, your partner in finance.